Hey, my name is James Nicholson and welcome to my YouTube channel. Good news, interest rates, mortgage rates are going to significantly drop by the end of 2025, according to this investment bank. Now, there is some more positive news at the moment. Recently, the news hasn't been so great. We've had interest rates going up over the last 2 weeks, and we've had back-to-back videos talking about that, which is really not positive news for a lot of people. Also gives the people uncertainty. Do you fix a rate now or do you wait for rates to drop? Well, this video is going to talk about what Goldman Sachs think. And they have a fairly good track record on this type of stuff because they're investors and they need to make money from predicting things correctly. Whereas the Bank of England's forecasts have been wildly off. In fact, the Bank of England said at this point right now, inflation would be at 2.7%. They were only saying that 2 or 3 months ago. It's at 1.7%. So their forecasting is massively off. I'm going to talk about how much interest rates are going to drop to, how much potentially that could save you per year. It's a lot, and much, much more. So before we jump into this video, if you haven't done already, do subscribe to the channel over there and hit the bell notification. We're on the way to 32,000 subscribers, which is awesome. And smash like, tickle like, do something to that like button over there. That really, really helps me with the YouTube algorithm and helps get more views on the channel. So let's get into this. Who are we talking about? Goldman Sachs, we already said that. And these investment banks, they do have better predictions than a lot of economists and the Bank of England themselves. I mean, the Bank of England data is so wrong, is absolutely unbelievable. It's literally like they plucked a number out the air and just have a guess. Whereas these guys, they need to make money, and banks do make money by predicting stuff correctly. And not always will they be correct, but I would say more likely than the Bank of England themselves. So Goldman Sachs is saying that with the fact that inflation is massively under the Bank of England forecast and it's below the 2% target, we could be looking at lower interest rates a lot sooner than we were expecting. Now, that flies in the face of the news in the last week or so, because right now we're in a temporary bubble. We've got the Labour budget next Wednesday, which gives uncertainty to the markets. You've got the US election at the moment, which they say is on a knife edge. I don't think it is, but they say it's on a knife edge in order to get people watching the news. And those give uncertainty to markets. And so right now, swap rates, the rate that the banks that we borrow from, they borrow at. So we borrow from HSBC and NatWest and those types of people. They borrow from JP Morgan Chase or Goldman Sachs or bigger banks, right? That's who they borrow from. And those rates have gone up temporarily. So my advice has been, if you have a mortgage that expires anytime soon, fix a rate now, because if the rates are right and Goldman Sachs are correct, you can move on to that better rate before you actually complete. So that's very, very important here. So Goldman Sachs, they're saying that they feel that the base rate, the Bank of England base rate, will be 2.75% by November. Base rate. And that's based off the fact that they feel that inflation is still going to drop. You've got potentially China not doing so well. That could mean that they flood the Western world with cheaper goods in order to keep the economy moving over there. And that could maybe cause deflation. Hopefully, the wars start de-escalating in Russia and Ukraine and Israel. That's something that hopefully will happen over the next year as well. So looking at that, they're saying the Bank of England base rate will drop significantly. Based off this, you can look at what other central banks are doing around the world. We've got the European Union that has cut rates to, I think, 3.5%. The Canadians this week also cut by 0.5 percentage point as well. The Americans cut by 0.5%, which means they're likely to keep on with that trajectory. So these guys believe, as do I, that interest rates are going to come down significantly. So what would this mean for you if it got to 2.75? They're saying that mortgage rates, the best rate in the market at that scenario, would drop to just 2.5%. Now, how can it be cheaper than that? Remember, these banks that you borrow from borrow on a swap rate, so it's not actually based off the Bank of England rate. A little bit it is, but not totally. But also they have fees on top, right? So they make money on fees as well. So the mortgage rates, they're saying by November, could be 2.5%. Now, how does that look and how much could that save you? Let's break this down. If you had a £200,000 mortgage, so if you had a £200,000 mortgage and today, right now, you have a rate at 4.5%. So at 4.5%, you would be paying £1,111 per month. Now, if we hit this rate and your mortgage drops to 2.5%, then your monthly payment would drop down to 897. That's significant. So you would save monthly £214, and on an annual basis you would save £2,568. That's a huge amount of money which people desperately need at the moment. And let's just hope in that time as well, wages go up higher than inflation, as they have done this year. It's not baked in, but it could happen. If that happens, then people will start to get a little bit more comfortable with things. As long as the inflation stays low, prices are then not rising anymore, affordability would significantly increase in this scenario on a £200,000 property or a £200,000 mortgage. That is really good. Now, who else is saying this? Because maybe Goldman Sachs are just picking out numbers to get publicity. Deutsche Bank, another investment bank, are also banking on this as well. They're saying that this will happen, but a couple of months later, so by early 2026, they agree that these rates will hit a similar amount. What other data have we got? We've got the Bank of England this week. They're in America. Andrew Bailey's in America doing talks, and he's saying inflation in the UK is now going to drop faster than they were expecting, significantly faster. And if you recall, a few weeks ago, they said they would cut rates more aggressively. Now, what they do by doing these talks and speeches is they're priming the market, letting the market know our intentions are likely to be pushing interest rates down significantly and faster, which would back what Goldman Sachs say. So they're not going to go out there and say, hey, you know what? We've got a meeting. I think it's November the 7th. We're going to cut interest rates by 0.5%. Otherwise, there'd be no point in the meeting if we knew ahead of time what was going to happen. But what they will do is tease the market so there's not any shocks or jolts or unexpected stuff. And that is what they're doing right now. They're saying inflation is going to drop faster than they thought. And they're saying we will be cutting, or we could cut, we will cut rates more aggressively. So this is good. Now, those of you that are going to be in the comments saying, well, you've been saying mortgage rates are going up. I have. That's what's happening. That's a fact. Right now, mortgage rates are going up. And you can protect yourself against that by picking and holding a rate right now, giving yourself the worst case scenario. Then if all of this comes true, then you can swap on to that lower rate. That's smart advice. And that's what you should be looking to do in the market. So yeah, you will probably get some videos over the next few days where lenders now look at cutting rates. A lot of stuff will change significantly after the budget and after the American election. That's not long. It's a week and a half or so left. After those two things happen, the markets will know this is the direction. This is the president that we've got in America, and this is what Labour's doing in the UK. And there will be a shift in the swap rate, I'm certain, at that point. I can't tell you if it will be up or down, but it definitely will move. And as inflation continues to drop, the Bank of England will cut rates and the swap rate over time will cut and will drop. You could potentially, after you speak to a broker, look at, in this scenario, getting a tracker mortgage. That could be an option right now, with rates way more likely to move down than to move up. That could be another opportunity or an option for you, but only if you could afford the worst case scenario that rates did go to the moon. Anyway, let me know your thoughts, questions and opinions, observations in the comments below. Do smash like, do subscribe, do check out all the other content on my channel, including this video right here.